All right, welcome to the Money Puzzle podcast. I am Brian Ramsey, that is Chris Vaughn, and that is Eric Douglas. And today's a pretty interesting topic. We were kind of sitting around in our meeting today, and we're like, hey, our producers just knocked something over there. So anyway, we were sitting around talking about topics we want to talk about, and we're like, well, what better topic to cover than kind of what's happening in the world today? Yeah. And it is the last week of February of 2022. So obviously it's the invasion of Russia into Ukraine. And so we thought, what a better topic to cover than just what happens to the market or what affects the markets when you have a major event around the world.
Yeah.
So we're just going to sort of talk about, I don't know, we've got 5 or 6 different topics. Just going to sort of do it around robin style like we normally do, and we'll just kind of go from there. So
I think more than anything, we want to clarify, we are not breaking down the conflict in any way, shape, or form.
Correct. Yeah, this is purely how it affects the market. So
yeah.
That's it. This is not...
We are not geopolitical experts by any means.
No. But if you were in our meeting this morning, we certainly were, because we knew how we knew how to fix the whole thing.
We had everything solved.
Oh, we had everything solved, but they're not going to call and ask us how it is.
Right.
So, all right. So one of the obviously major topics is Russia is a major supplier of energy.
Yeah.
So how does that affect, Chris? How does that affect the world's gas prices? And obviously that's a trickle-down effect, right? So
it is, yeah.
Gas prices, it's to oil producers, it's to oil distributors, and it's to gas stations, right?
Well, so you've got countries around the world are really upset with Russia for obvious reasons, and you get any series of boycotts, things like that. There is a concern, whether real or unreal, that the energy supply, especially of oil coming from Russia, could be cut off. So countries might be choosing to cut it off. It could also be cut off by the conflict itself. So the concern is that if the supply is cut down, so you don't have as many countries supplying it, the demand is not going away. In fact, it's still going up. That's what's going to cause energy prices to go up dramatically. And Russia's a huge supplier of energy. I don't think people realize just how big it is.
Well, the cost of oil in and of itself, just this year alone, has already gone up about 26%.
Yeah.
In just two, I mean, we're a hair away from March 1st. So the first 2 months of the year, the energy prices or the price of oil itself has gone up 26%. That's a huge jump in 2 months amount of time, strictly based on really what's happened in the last couple of weeks. It's also worth noting, to clarify, you were talking about demand or the appearance of demand, because nobody's really stopped buying Russian oil at this point. But the thought is that there's an issue with any type of, if there's any type of bottleneck at any point in the supply chain, that there will be an increased demand with less supply to be able to account for it. So that, I think, more than anything, once again, we always talk about how irrational the market is and how it's so emotional. It's the fear of
exactly right.
a decreased amount of supply along with an increase in demand.
Yeah, I think one of the other major fears is that it's really about the countries in Europe that Russia funnels energy to. Is what happens if Russia, for whatever reason, so there's 2 fronts. What if Russia cuts off the spigot to them?
Exactly.
To say, and then number 2, it's, do those countries want to get involved in this conflict? Because if they do, Russia could then turn the spigot off. And that's why a lot of these countries surrounding that region, they don't want to get involved in this because, one, I'd say for the most part, they don't want to see this invasion. Well, I'd say they don't want to see it. But number 2, they don't want to disrupt their energy supply.
Well, Germany gets something like 75% of their oil from Russia.
Right.
So they need that. They don't want to make Russia too terribly mad. And we always think about how Russia's this huge, massive country. They have an economy about the size of Italy. It's not like their economy is anywhere near the size of most of these other European countries. But once again, to your point, the effect of losing that energy source to an economy the size of Germany's, now we're having a much bigger issue with other foreign markets, much greater and much bigger than Russia alone.
And I would think that gets amplified by the people who study history know that when you have countries cutting off other countries' oil supply, some people might say, well, that's not a big deal. Well, the whole Japanese Pacific theater in World War II started because of oil supplies being cut off. So there's a historical precedent that even though we may not be anywhere close to that kind of thing now, who knows, there's a historical precedent that scares people. And to Eric's point, the markets are totally emotional. So when you have fear introduced into the markets go sideways.
Yeah, just as a quick note, when we're talking about the price of oil, and you see the price of crude oil, and they talk about it on the news, that's above $100. It's the first time in, I don't know, X amount of years,
Right.
it's above $100. But just know that is the futures price for oil.
Correct.
Right? So they're trading for futures, meaning you're buying a contract, and at some point down the road, when that contract expires, they deliver a barrel of oil to it. So really you're, 60, 90 days out for that particular oil. But just because the conflict goes up just means that companies that, like gas stations or whatever, really they should be waiting, 60, 90 days or whatever that contract is before they raise prices, because the oil that's in gasoline right now, they were buying it $40-50
Right.
a barrel that they were getting months ago. So there's some confusion around exactly how that all works, and that's a whole different show in itself.
That's
That's
a whole series
that's a
of
whole,
shows.
yeah, it is. But just know that's kind of how it works, okay? All right, so number one, let's talk about stock prices. So companies that are not even involved in the oil business that we've been talking about, that are not domiciled in Russia, because we'll talk about that in a few minutes, but why are stock prices affected when they don't have anything to do? Why is Kohl's or Kroger, why are they affected by what's happening overseas?
Emotion. I would love to give you some long, lengthy disposition about what's happening. It's really emotion. And fortunately or not, in today's world, most stocks have become increasingly correlated to some degree. So you can show, we can list 100 different stocks on a chart. And if you watch the intraday moves of each one of those stocks that might have zero correlation in any type, whether completely different industries, completely different sizes, you can watch the trading throughout the day when you have major events that are occurring like today. They're going to trade very, very similar throughout the day and throughout the weeks. It really is just, for the most part, emotion. Another stat that I saw, 76% of all companies that have reported earnings so far have beaten their estimates. That's a huge deal. That's a big number.
Yeah.
Most companies are doing fairly well.
Yep.
You would never know that right now looking at the stock market and what it's done through the first few months of the year, really the last 3-4 months. We're in correction territory, but most of that's because of the emotion from this Russian-Ukraine conflict.
Well, I would take that another step. We were talking about the price of oil just a minute ago. Well, if you think about the retailers out there who are selling clothes, well, oil doesn't affect them. Well, yeah, it does. Because the clothes or the products or whatever it is that they're selling in their stores had to get to that store.
Absolutely.
And those come in with trucks, and trucks run on diesel fuel, which comes from oil. So oil is a huge driver in all these things. The one I was explaining to my kids the other day when they were trying to grasp this, we were talking about inflation. And I said, how many vegetables, when we go up to the grocery store, are grown in a field behind the grocery store? And the answer is 0. Everything has to be shipped in trucks. So these companies, their expenses are going up because of just simply trying to get supplies to the end user. And then the emotion kicks in. Well, what if they won't be able to get the supplies into their stores? Now their sales go down and therefore profits go with them.
But that hasn't occurred yet.
Right.
So
It's
the fear of any potential future loss
Exactly.
that might occur in any one of those individual stocks, which is obviously affecting the price of those stocks.
Yeah. So when it comes to domestic stocks, and domestic stocks are companies that are actually domiciled here in the United States, by the way. That's the definition of it. But what we'll find out is starting in, let's say, April timeframe, we'll see, because that's when earnings will start to come out for the first quarter. That's when we'll really see the true effect of, are we still going out and spending money? Right, that's what we're really going to find out. It's kind of that April-May time frame. But all right, so let's talk about stocks that are domiciled overseas. That I think they're going to be more affected, especially kind of in the European, Southeast Asia, because that's where Russia is in that territory. So how would they be affected, in your all's opinion? How are they affected more than companies that are domiciled here?
Eric, why don't you start it?
They're closer to the action, so to speak. So whenever you invest, especially in foreign investments, foreign stocks, you're taking on an additional layer of geopolitical risk. Obviously for the better for us in the United States, we are sheltered for the most part from all of that geopolitical risk that you see overseas. We just have a much bigger, far more robust economy. We are much more stable geopolitically. I mean, I know we have a lot of infighting, whatever side of the political aisle you might be on. And it's not, at times when you watch the media and read the headlines, it might seem unstable here locally, but compared to what's happening throughout the rest of the world, it's night and day. It really is. We're so far more stable. Plus, you have to remember, we have oceans on both sides of us. So a lot of these conflicts, I mean, there's a whole ocean to get before they ever come to reach us.
Right. Yep.
So you just have far more instability, when you're investing internationally. We made a decision last year. We moved away from investing internationally.
Right. Yep.
It's proven to be very, very strategic on our part, just because we saw what was happening. All this applies to COVID, too. We had all these COVID restrictions that were occurring locally, but they were far worse in a lot of other countries.
Yeah.
So, I mean, just to follow up on that, the geopolitical part of it, the reason why international investing is considered to be more risky than domestic investing is because we have no control over the way that those governments are going to react to whatever stimulus is out there for them. So that's the reason why international investing is a little bit more risky. We can't control it.
It's difficult, too, to be a passive investor with foreign stocks because if you can just track like a foreign or an international index, those foreign indices don't really track any type of geopolitical risk that might be occurring on the ground that you can't really pick up within an index itself. So they're just far more volatile.
Yeah. Yeah. And so the other quick note I'll just add is that I believe it was over the weekend, some of the European countries decided to not allow Russian banks to intervene in the SWIFT program, whatever that is. We were talking about this before the podcast. I don't know what SWIFT is.
I'm going to have to read up on that.
We didn't have time to really research that. But my point is that there are some quick decisions that lots of countries can make that will totally impact in the banking system. For example, that's going to be a huge impact in the European banking community. So that's one of those things that the appetite for international right now is got to be lower.
Really low.
Yeah, really low. I'd say across the board.
Yep, agreed.
Just because of the instability. So it is an issue when you invest internationally. I wanted to bring it up because we've made a point in our portfolios to get out of that. And our timing, we obviously didn't see this coming, but our timing was pretty good that we didn't necessarily see that. I mean, they were talking about it 6-9 months ago when we decided to do that, but about what was going to happen or potentially happen. But we just got lucky on that one. So all right, so let's talk about. When you have world events like this, and yes, we're specifically talking about what's happening in Russia, but there's other world events that happen. And some of them happen in the United States, but they also happen overseas where, you might think, well, that's on the other side of the world. Why does that impact me? China, for example, is now, I believe, in my opinion, has sort of a green light to, is it Thailand?
Taiwan.
Yeah, Taiwan. And I believe that Russia and China got together and said, hey, you go first and I'll go next. And we'll just see what happens.
We know they got together. We don't know what they discussed.
Yeah, we don't. And it'll never be released.
No.
But my guess is, that could potentially happen. But hopefully it doesn't. But if it does, that's just another component of something happening internationally.
Yep.
That a lot of people say, well, how does it affect my 401k? I've got it. I work at a company here in the United States. How does that affect me? So
okay. Well, here's a great example. Over the last year, we've had a problem with computer chip supply. Well, I guess which country is one of the biggest manufacturers of computer chips, and it's Taiwan. So in your 401k, let's just say that you own Ford stock. Traditionally, that's a great company. It's a big one here locally. But Ford doesn't make its own computer chips. They have to buy them from somewhere else. And if they're buying some of them that are manufactured in Taiwan, now it becomes a supply issue. So that could cause Ford stock to go down in this example, which would affect your 401k if you've got that kind of a holding.
Yeah, and only for about another year because they're manufacturing the largest chip manufacturing plant built in the United States out in Arizona.
Yeah,
so
exactly.
I believe it's in Arizona.
Which is one of the reasons, something like that. Which is one of the reasons why American companies have a desire to do that to eliminate these problems in the future. But they're still very much there right now.
Oh yeah, absolutely. So, but I guess the point that we wanted to make here was there's just a lot of investor fear that causes the market to be kind of volatile, right? Yep. Because as an individual investor, you're you get to a point you're like, oh my gosh, this is happening over there, so now I'm gonna sell out of my portfolio. Right. And we've gotten a couple of phone calls, right? I mean,
yeah.
we get a couple. It's like, oh my gosh, the world's coming to an end. The world's coming to an end. And so I want these guys to now talk about we talk about investor fears and things that are in the market that cause people to think. I don't want to say irrationally, but that's kind of what it is, right? But so when you look at any specific time period, you might say, okay, here's this Russia thing. The world's coming to an end. And it really never comes to an end. Right? So why don't you guys bring your pieces out and each of you talk about it. Chris, you've got one, and then Eric's got one, and I'll take this
I got to put the cheaters on, though.
Yeah. So anyway, why don't let's just start kind of go around, talk about what piece you've got, and then we'll have Eric, and then I'll talk about this piece right here. So, Chris,
well, I mean, we've got a list here that was put out by LPL Research on some big events that have happened historically and what the stock market did immediately, and then how long it took to recover back to where it was, right? So, for example, and I'm going to go way back, and I'm going to start back Pearl Harbor. Right, we kind of mentioned that one a minute ago. So what did Pearl Harbor do? This is the S&P 500 now. In one day, it dropped 3.8%. Right, so that's a big, big number.
Especially back in there.
Exactly,
in those days,
and it ended up going all the way down to 19.8%. So massive drawdown, right? But it took 143 days to get to the bottom, and it took 307 to get back to where it was pre. So I just looked that one up just for fun. 307 days later is right about the time that the Battle of Midway happened. So all it took under an extremely bad situation like this was the emotion of seeing things starting to change the other direction, and the market's there. So that was one that I picked.
Yeah, I mean, I read another analysis, and this one started off very specifically saying they weren't endorsing war in any way, shape, or form. But they were basically saying most of the negative stock market action when it comes to conflicts like this occurs before, with the fear of what could happen. Usually once there's any type of fighting, to your point, it turns around. It turns around. And it did. It happened last week, and we've had today's down a little bit, but we had 2 fantastic days to cap off the week last week, kind of out of nowhere, which would
I think that goes back to the emotional component.
It would defy logic because we're past the point of fear. Now we're in the middle of it, and it's going probably better for most people than they thought with Ukraine really fighting back and it's sticking this thing out. Now, who knows where we'll be in another week or two. That could all change. But, all that to say, most of these world events, and you took like the worst one. When you
I went for the big bad one of the group.
Yeah, but you look at most of these other world events and some, more recent ones that have occurred, U.S. pulled out of Afghanistan in 2021. I mean, there was a total drawdown of 0.1%. Iranian general killed in the airstrike in 2020. 0.7% drop. Saudi Aramco drone strike dropped 4% total. Yeah. That one took a total of 41 days to recover from that 4% drop. Most of these world events, once again, I always talk about zooming out. When you look at the stock market, you have to zoom out and see everything through a bigger lens, and you can see, what feels like a major drop turns into a blip on the radar screen as we recover and move well past that point.
See, I think looking at those things, to your point of stepping back, the best example that I ever heard, if you're looking at what the stock markets have done over time and you're standing really close to it, what you're going to get is you're going to see all the ups and downs. But when you step back, you see more of a trend line. It's kind of like looking at a mountain. If you're standing on the mountain, you see every crevasse and every rock and every bad thing you got to climb over. When you step back into the valley, what you see is the line of the mountain going up. And that's kind of the way that it looks.
I'll even take that analogy one step further. I heard this one. I thought this was really cool. It's like a mountain climber using a yo-yo climbing up the mountain. Mm-hmm. The stock market is the yo-yo. It goes up and down. It goes up and down. It bounces, right? But the whole time, it's still going up the mountain, and over time, it's still increasing in value.
Great example.
So I thought that was a really cool analogy. But to go kind of even beyond that, when you look at, so what I've got is 87 reasons why people did not invest in the stock market. And it basically takes over the past 87 years and talks about a major political event that occurred in the stock market or throughout the world that year, and really what's the stock market done in the backdrop of all of these events occurring. 1993, World Trade Center was bombed. 1994, the Fed raises interest rates 6 times. Does that sound familiar?
Yes, it
like
does.
anything that might be happening right now, right?
Yeah.
In 95, U.S. troops were sent to Bosnia. There was the Whitewater scandal in 96 and 97. Hong Kong reverts back to China. 98, President Clinton was impeached. Y2K scare in 1999. Jeez, that feels like yesterday.
Oh my gosh!
Everybody scared their computers were going to blow up when the clock struck midnight on 2000.
Couldn't get money out of your ATM.
Oh, that was that turned out was a big nothing burger too. But
Wow.
every single year, and you can pick a year, and tsunami in Asia in 2004, interest rates rise in 2006. 2008, the worst market conditions since the 1930s. Well, what happened after 2008 and 2009? We've had the best 10-year run in the market. Well, 12-year run in the market ever since then. So there's always a reason not to invest. And yet, those are opportunities lost if you look in the rearview mirror that you should have invested throughout the entirety of that time. So.
Yeah. So this third piece, this is a pretty interesting one. I've had this one. This is by a fund company called Legg Mason. You can actually go to their website, just Google Legg Mason and type in Time Magazine up in the search bar, and you'll get this piece. I'm sure it's been updated. This is one we've had in the office for a while. It's slightly dated. But the interesting thing is when you unfold this, and I know you can't see it, you don't have to zoom in, but essentially what it does is it breaks down and shows you all these time periods of horrible Time Magazine covers where they're essentially saying, hey, this is everything that we just been talking about, right? Is all these every single year that Eric's talking about. And it basically says, look at the cover of Time Magazine. You're going to get a horrible piece of news. And then look what the market does afterwards, right? So that's what this piece is. It's really interesting. But on the inside cover right here, it talks about the 4 worst periods since they've been tracking it. There was the bear market of 1973 for those that are millennials. It's 19 in front of that, not a 20. And then you've got the 1987 bear market. That was Black Monday, Tuesday,
Monday or Tuesday, yeah.
Whatever it was.
It was Monday, yeah.
Monday. And then you have the bear market, of course, of 2000. That was kind of the dot-com issue. And then you had the real estate debacle of 2008. And it just gives a number. So from peak to trough, meaning from the high from the high where the market was at the time to the low, and I'm just going to go back to 2008 because that's probably the more recent one, right? So this, and again, you go back and look, and this thing is only up through 2015. So it's slightly dated. I'm sure if you were to get the most recent one, it would have all the way up till probably last year. But anyway, from peak to trough, so from the high all the way to its low, the S&P 500 was down 54%. It's where it ultimately was the ultimate low. If you look 1 year after that low, it was up 70% from that low. 5 years later, it's up 200% after that low. And again, we don't have a 10-year number. This goes 1, 5, and 10 year. So we don't have a 10-year number on this. But anyway, the point being in this whole conversation is that things that happen in the world are obviously disruptive, right? It causes the market to be disruptive. And, and it can affect the numbers. We'll find out at the beginning of April into March, or really mid-April into March, when we get into earnings season.
April into May.
Sorry, May.
There you go.
I knew it started in MA. But we'll get into earnings season, and we'll find out really how companies did. Because really, Chris hates this term. At the end of the day, which we said we were going to borrow from our vocabulary.
Yes, we did.
But in all reality, at the end of the day, companies that we invest in, that are invested in the mutual funds that we own or the ETFs that we own, they should trade based off the earnings that they produce. End of story, right? That's really what they should trade off of. However, there's all this noise that happens between, the 4 times that they report earnings throughout the year, and it can cause the stock to do all this good stuff. But when they report earnings, that's really how we look at it and see, the kind of health of the company. And it sort of, goes like this, and all of a sudden the earning comes out and it says, okay, this is where it should be, or this is where it should be, and then it starts all over again. But what you can't do, and we see this over and over, is have your emotions take over what you think about a particular company. So, for example, if you like Apple and you like their product and you use their product and you're aware of their product and you like their stock, own their stock. But don't think of it, there's disruption over in China and Russia, and all of a sudden, the iPhone's still going to be a good phone. They're still going to produce as much as they possibly can to meet all the demand. So you just can't get that emotion and say, well, I'm going to immediately sell out Apple because something crazy is happening over in that part of the world. So I guess that's kind of the point, right?
Yeah, these are temporary hits.
Yeah.
They're not long-term. When you're dealing with companies that are good, solid companies, every good relationship has ups and downs, but if it's a good company, it will, over time, eventually go up.
The fundamentals of investing never change.
Absolutely.
Buy good stuff. Let them do what they're supposed to do.
Yep.
Leave it alone.
Yeah, that's right. So I guess that's a good way to end this show is exactly what Eric said. I'm not going to repeat it because you guys heard it. And if you didn't, hit the backspace 10 seconds a couple times, you'll be back to hear his last statement. So, all right. So that's another edition of the Money Puzzle Podcast. We are next week going to release one on taxes. We're actually going to shoot that in just a second. That's going to be a really interesting one. And just as a quick note, where the taxes came from, we were just out in Arizona. We spent the end of last week out in Arizona doing a little taping, which hopefully we can release here in a couple of weeks on what that is. Actually, it's coming out in a couple of weeks because this will come out in a couple of weeks, right?
4.
Yeah, so it's about 4 weeks from the day we're taping this. But I think this will be released in a couple of weeks, or at least next week. But
Something like that.
Anyway, it's April 2nd is our big announcement. So just keep that date in mind. We get prior to that, we'll make that announcement. We're pretty excited about it. Again, we were out in Arizona, and one of the topics we got to discuss out there was taxes. And so we thought, let's do another podcast on it and talk about other taxes other than what we talked about on that show. So anyway, that's it. I'll let Eric sign us off for the day, and we'll see you guys next week.
Yep. Thanks for watching. Thanks for listening. If you're watching on YouTube, make sure you hit that red subscribe button. Leave us a rating and a review. That'd be very much appreciated. If you're listening on your favorite podcast hosting company, please leave us, once again, another rating and a review. Helps us spread the word around. If any of our content speaks to you or thinks might be relevant to anybody that you know or love, please feel free to share the content with them as well. We appreciate it. Till next time. The information given herein is taken from sources that IFP Advisors, LLC, doing business as Independent Financial Partners, IFP, IFP Securities, doing business as IFP, and its advisors believe to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors. This report may not be reproduced, distributed, or published by any person for any purpose without IFP's express prior written consent. Securities offered through IFP Securities, LLC, doing business as Independent Financial Partners, IFP, member of FINRA and SIPC. Investment advice offered through IFP Advisors, doing business as IFP, a registered investment advisor. IFP and Family Wealth Planning Partners are not affiliated. The information given herein is taken from sources that IFP Advisors, LLC, doing business as IFP, IFP Securities, LLC, doing business as IFP, and its advisors believe to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors.